EPK Capital presents Deep Dive on Godrej Consumer. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host Kunal. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Godrej Consumer. The Godrej Legacy, a foundation of trust. Godrej Consumer Products, or GCPL, is a company with a history that is inextricably linked to India's own journey. The narrative of the Godrej Group begins in 1897, an era of significant national change. Its founder, Ardeshir Godrej, was a lawyer-turned-entrepreneur whose early failures did not deter him. He found his initial success in a locks business, but his commitment to innovation and social values quickly set the group apart. In 1918, the company launched the world's first soap made with vegetable oil, an act of innovation that was also a powerful statement of support for the Swadeshi movement against the British Raj. This deep-rooted legacy of trust and integrity is not just a historical footnote, it is a fundamental competitive advantage in the consumer goods sector. A century-old brand, trusted by over 600 million people daily, can command a level of customer loyalty and brand equity that is incredibly difficult for newer companies to build. 2. This trust is a significant, albeit intangible, asset that underpins GCPL's market position. The company and its promoters. Today, Godrej Consumer Products Limited is a focused, fast-moving consumer goods (FMCG) entity. It was established in 2001 following a strategic demerger from Godrej Soaps Limited, allowing it to concentrate on its core consumer-facing businesses. GCPL operates primarily in three key segments: household insecticides, hair care, and personal care, where it holds leadership positions in multiple markets. The company's ownership structure is a crucial factor in its strategic direction. The Godrej family remains the majority shareholder, exerting significant influence through the holding company, Godrej Industries Limited. A recent and notable development is the family business realignment, which saw Adi Godrej and Nadir Godrej take control of the listed entities, including GCPL, while other family members oversee the unlisted businesses. This strategic separation is a critical step forward. It is not an act of internal discord, but a proactive, forward-looking move designed to eliminate potential conflicts of interest and better align ownership with a clear vision for each part of the conglomerate. This decision, described as respectful and mindful, could provide GCPL with greater strategic focus and agility, potentially accelerating long-term value creation. This contrasts sharply with the messy public splits seen in other family-run business empires, suggesting a mature and deliberate approach to corporate governance. Decoding the numbers. A 10-year financial analysis. A high-level overview. An analysis of Godrej Consumer Products over the last decade reveals a dual narrative. Consistent top-line revenue growth juxtaposed with periods of significant bottom-line volatility. The company has shown a remarkable ability to increase its sales, growing from approximately R7,600 crore in the fiscal year 2014 to over 14,000 crore in fiscal year 2025. This indicates a strong and expanding market presence both in India and internationally. However, a closer look at the financial performance shows a more complex picture. For instance, the first quarter of fiscal year 2025 saw a 10% year-on-year consolidated revenue increase, yet the net profit remained flat. This divergence between sales and profit is a direct result of margin pressures, which will be discussed in detail. The most significant financial anomaly is the reported net loss in fiscal year 2024. A deep dive into the company's financial statements reveals that this was not due to a failure of its core business operations, but rather a massive one-time, non-operational loss of over R7,300 crore classified under other income in the March 2024 quarter. This figure is likely related to a major write-off, asset impairment, or an exceptional litigation settlement, as a similar item was noted in the first quarter of fiscal year 2025. it is important to distinguish this non-recurring event from the company's sustained profitability in its core business. GCPL's operating profit margin has historically been in the range of 18% to 22%. However, recent reports have highlighted a decline, with the EBITDA margin decreasing by 260 basis points in the first quarter of fiscal year 2025. This pressure is attributed to factors such as demand headwinds in the Indian business and the impact of high-cost raw material inventory. The company's strategic focus on driving volume growth, particularly in price-sensitive markets, sometimes comes at the expense of short-term profitability. This is a common trade-off for FMCG companies and explains why strong sales growth may not always immediately translate into a corresponding increase in net profit. Debt and financial leverage. A key metric for financial health is the debt-to-equity ratio. Over the past 5 years, GCPL's debt has been trending upwards, peaking at 33.7% in fiscal year 2025 from a low of 8.3% in fiscal year 2023. While this represents a significant increase, it is essential to understand the context. The company's debt level is still comparable to the consumer staples sector median of 27.0%. The increase in debt is not a sign of operational distress, but a calculated, strategic choice. GCPL has been using this capital to fund major initiatives, including the acquisition of Raymond's consumer care business for Rs 2,825 crore, which added brands like Park Avenue and Kama Sutra to its portfolio. It is also investing in large-scale capital expenditures, such as a new Rs 250 core manufacturing facility in Indonesia, to enhance its production capacity. This investment in future growth necessarily increases debt and finance costs, but it is viewed as a necessary trade-off for long-term expansion. What the chart says: technical analysis. A technical analysis of GCPL's stock chart provides a glimpse into investor sentiment and price action. The stock has demonstrated strong long-term performance, with an impressive 5-year return of nearly 85%. Its all-time high was reached at RE1 541.85, a significant resistance level for future price movements. Support and resistance levels. An examination of the price chart reveals several key levels that investors are watching. Resistance levels. The immediate resistance is in the range of Rs1 265 to Rs1 300. A sustained break above this range could signal a continuation of the uptrend. The next major resistance lies at the all-time high of Rs 1,541.85. Support levels. The primary support zone is around Rs 1,200, followed by a stronger band between Rs 1,160 and Rs 1,180. These levels have historically acted as floors where buying interest has emerged. Key technical indicators. RSI, the Relative Strength Index, RSI, a momentum oscillator, is currently in the mid-range of 48.3 to 51.87. This reading indicates that the stock is neither overbought nor oversold, suggesting a period of equilibrium and consolidation rather than a strong directional trend. Moving averages. Moving averages are used to smooth out price data and identify trends. The stock is currently trading below some short-term moving averages, but remains above key long-term averages, like the 200-day simple moving average, SMA. This mixed set of signals suggests that the stock is currently in a consolidation phase. The market is digesting recent information, such as the latest quarterly results and valuation concerns, and is awaiting a new catalyst to move in a clear direction. The Benjamin Graham method, a value investor's perspective. From the perspective of a classic value investor, the analysis of GCPL presents a significant paradox. The approach, pioneered by Benjamin Graham, advocates for buying stocks with a margin of safety, purchasing a stock at a price significantly below its intrinsic value. This method relies on a set of quantifiable criteria to identify a defensive investment. Applying the Graham checklist. A systematic application of Graham's principles to GCPL's stock reveals the following. Earnings. Stability. The company generally passes this criterion as it has a long history of consistent profitability. The fiscal year 2024 loss was a one-time event that does not reflect a breakdown in its core earning power. Financial condition. This is where the company fails the test. Graham's rules for industrial companies require current assets to be at least twice current liabilities. GCPL's current ratio is 1.0, failing this requirement. Furthermore, while Graham's rules on debt have some flexibility, the recent increase in its debt-to-equity ratio places it at the higher end of the industry, which would be a point of concern for a conservative investor. Moderate valuation. This is the most significant hurdle and a major point of contention. Graham suggests a price-to-earnings PE ratio below 15 and a price-to-book PB ratio below 1.5.23. GCPL's current PE ratio is in the range of 67.4 to 81.9, while its PB ratio is 10.3 to 10.7. These numbers are multiple times higher than Graham's recommended thresholds. Valuation assessment. The core conflict in this analysis is the fact that a defensive consumer staples company is trading at valuations typically reserved for high-growth technology or disruptive firms. A discounted cash flow (DCF) valuation model estimates the company's intrinsic value at approximately R$417 per share, suggesting the stock is overvalued by 67% compared to its current market price. The high valuation is further highlighted when compared to its peers. The market appears to be assigning a significant premium to GCPL, not for its current financial metrics, but for its future growth potential. Investors are betting on the company's ability to execute its strategic vision and capitalize on the immense, underpenetrated Indian and emerging markets, which may not be fully captured by conservative valuation models. The case for and against a balanced view. The bull case, reasons to be optimistic. A compelling argument for GCPL revolves around its strategic execution and growth drivers. The company has a clear plan to boost market share and profitability, which includes a focus on efficiency through SKU rationalization, having reduced stock-keeping units by over 23% in Indonesia. It is also aggressively expanding its rural footprint in India through initiatives like Project Vistar, aiming to increase accessibility for a massive consumer base. GCPL's international footprint is a key growth engine, with international markets contributing over 40% of its revenue. The recent Rs250 crore investment in a new manufacturing facility in Indonesia is a testament to its long-term commitment to that market. Furthermore, the company's focus on disruptive innovation and strategic acquisitions, such as the acquisition of Raymond's consumer care business, is opening up new, high-growth categories like male grooming and sexual wellness. The bear case, reasons to be pessimistic. Despite its strengths, several risks could pose a challenge to GCPL's performance. The company is currently navigating significant near-term headwinds, including ongoing margin pressure due to high raw material costs and intense price-led competition in markets like Indonesia. This has directly impacted profitability, which has remained flat or even declined in certain periods. The most significant concern, however, is the stock's elevated valuation. The high PIE and PB ratios compared to its peers suggest that the stock has very little room for error. Any failure to meet high growth expectations or a slowdown in its key markets could lead to a significant correction. Finally, a major legal risk looms over the company in the form of the toxic hair relaxer lawsuits. The full picture, important checks, scandals, and controversies. A diligent analysis requires an investigation into any major scandals or controversies. The most material and ongoing legal issue for GCPL is a multi-district litigation in the United States involving its subsidiary, Strength of Nature. This litigation, involving over 10,000 plaintiffs, alleges that endocrine-disrupting chemicals in hair relaxer products caused uterine and ovarian cancer. While the company denies these allegations, and there have been no settlements or verdicts yet, the sheer scale of the claims and the potential for substantial future liabilities make this a serious, unquantified financial risk. It is important to note that controversies related to delays in project execution at Godrej properties are for a different listed company within the Godrej conglomerate and are not relevant to GCPL. GCPL, for its part, has a generally well-regarded corporate governance framework, having received the Golden Peacock Award for corporate governance in fiscal year 2023. Global market position. GCPL is a significant player in the global consumer goods market, with a presence in over 85 countries. It is a market leader in household insecticides in India and Indonesia, and is a dominant player in the hair care market for women of African descent. Its focus on emerging markets has been a key driver of its international growth. However, there is a notable area for improvement in its sustainability practices. A recent assessment by the World Benchmarking Alliance gave GCPL a below-average score, highlighting opportunities to improve in areas such as reducing global greenhouse gas emissions, water use, and making stronger public commitments to worker health and human rights. In an environment where consumers and investors are increasingly prioritizing environmental, social, and governance (ESG) factors, this represents a significant missed opportunity to build a powerful new competitive moat and a potential risk to the brand's reputation in the long term. Conclusion: a balanced summary. Godrej Consumer Products is a storied Indian company with a deep legacy of trust and innovation. The analysis reveals a business with a clear strategic vision for growth, supported by consistent revenue expansion, a calculated approach to capital investment, and a strong international presence. The company is actively addressing operational efficiencies and expanding into new, high-growth categories. However, this promising picture is not without its complexities. The business is facing near-term profitability headwinds, and from a traditional value investing perspective, the stock is trading at a significant premium to its fundamental value. The market's valuation appears to be pricing in a flawless execution of the company's growth strategy, leaving little margin for error. Additionally, the unresolved hair relaxer lawsuits represent a material and unquantified risk that could impact the company's financials in the future. Final outlook and disclaimer: GCPL is a stock for investors who believe in its long-term growth story and are comfortable with its current high valuation. The investment thesis relies on the company's ability to deliver on its strategic promises and translate its revenue growth into sustainable, long-term profitability. This report is for informational and educational purposes only and does not constitute financial advice or a recommendation to buy or sell any stock. The analysis presented here is based on publicly available data and may contain forward-looking statements. Investing in the stock market involves inherent risks, and it is essential to conduct your own due diligence or consult with a qualified financial advisor before making any investment decisions. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.